we are starting today. We are starting with Abuto Limited. Okay. So Abuto Limited is a private company in the printing industry. It was established by the Abuto family some 20 years ago with Mrs. Abuto as the managing director. Now, have you seen the nature of this
Yes,
business?
I can hear you, sir.
Have you seen the nature of this company? This company is established by a
Yeah,
family. You see, it is established by
a group of family.
absolutely. So this type of company, we call it close what company. You understand? So a
Close
company,
company, okay?
yeah. So a company which number of shareholders are not exceeding 5 persons. You understand? Okay.
Yes,
So
sir.
so the business has grown in size over the years, and the directors are now considering listing the company in the Ghana Stock Exchange. Right? So this is the financial statement. So the company, you see, they are now want to list the company in the what?
Yes, sir.
In the Ghana Stock Exchange, which means that the company, they want the company to what? To be owned by the public, not anymore private. So the reason why they are going to what? Public. So this is the financial statement of what of the company. So this one, the profit and loss accounts. And then we have statement of financial position. Okay. So we have additional information. Okay, so follow me here. The additional information we have: the share capital of Abuto Limited consists of ordinary share capital of no par value, issued at what? At 100 cedis per share. You see, have you seen how much they want to what?
Issue the shares.
Their share value, a unit share is okay. Now the independent valuer estimated the fair value of the property, plant, and equipment at 500,000. Which standard can you tell me this one is?
He stated it at 500,000.
Yeah, I'm asking. They have done valuation of the business, right?
Yes,
So
sir.
if you are in that shoe, they said an asset is valued, and this is the fair value of the asset currently. Which standard can you attribute this narration to?
IFRS 13
No, okay, it can go there also.
or 16. IS
Okay,
16.
absolutely. 16 and what?
13.
No, okay, 16 and 13, fine. And then 16, 13 and what? 36, right? So
Okay,
so
36.
so this standard we can do fair value of the asset. Now, so now let us move to item 3. We will understand all this before we zoom it. Now, so which means that if the asset is now valued at 500,000, then that means the asset is already having an original value, right? Okay.
Yes,
Now
before
let's
it
go
is
to the
increased to 500.
good. Let's go to 3. The inventory includes obsolete items worth 5,000 being held despite persistent advice by what? By the author to have written off. What does this one mean? This one means that the company is holding, when you look at their inventory, the inventory consists of what? 5,000 what? Absolute item, which was advised by what? By the auditor to rectify. Have you seen it?
Okay.
So in this
Yes,
case,
sir.
we are coming to do visual evaluation. Something must happen to this. Is that not the case? Good.
Yes, sir.
Now, receivables also include an amount of 12,000 resulting from bankruptcy of what? Of major customer. You understand? So you have receivables. There's a problem with what? With the receivables. The receivable are what? There are people who own the company and they are in bankrupt. So you are now coming to do business evaluation. What will happen to receivables? Now, Aboto Limited is not likely to realize any amount from this, but the director has refused to make any provisions. You see the whole thing. Okay, so
Yes, sir.
debtors will also have some effect here. We also have patent to represent a right to sell a special product. You know, patent is what? Under what? Under IAS
That is
what?
intangibles.
Intangible assets. And the intangible asset is falls under which standard?
38.
Thank you very much. So this product is expected to generate cash flow of what? Of 2,000 per annum indefinitely. Take note of this one. Indefinitely. So when you have an expected cash flow, what do we call it? If you have expected cash flow in the future, what do you do with that cash flow in the future? What do you do? No problem. When we get there, we will cross it, right? Now, 6. A discounted present value of future cash flow in respect of debenture is 20,000. Have you seen it? Debentures are which people? Debentures are which people?
So we are owing them.
Okay, thank you. So something will also happen to this value. Now 7. The 7 is having present profit after tax of Abuto over the past 4 years as follows. Please, have you seen it?
Yes.
Have you seen the profit?
Yes.
Okay, good. So the profit says what? It has given the what? The profit for the year, profit for the period. Have you seen this? So you take note of this one. If you are not careful, when you see profit, you should understand what they mean here, right? When you are doing business evaluation, you should know what they intend to use it for. Now, come to a corporate plan prepared by the director of Abuto Limited in 2018. Include the following: a plan prepared, corporate plan. So what does it mean, please? Now watch this one. You should be very careful with this, right? Have you seen that they have given you, they've given you what? A plan. Have you seen the plan?
Yes, sir.
Please, are you, if you are busy, you can go and come back.
No. I'm with you, sir. So let's
Okay,
go on.
okay, let's go. So have you seen the plan? The moment you see plan, what do you mean by plan? A, a corporate plan prepared by directors for the limited. They planned this one in 20 what?
18.
2018. And have you seen what they've given you here? So giving you this one means what? They are what?
Forecasting.
Absolutely forecasting. You understand? So they did the forecasting as at
Yes.
20. They did the forecasting from what? 2018. Are you with me? Good. So they did
Yes,
the
sir.
forecasting for 2018. And when you look at this company, what is the accounting year? Or what are they expecting you to prepare this valuation? What is the accounting year? Accounting year for the business ended when?
The accounting year ended 2020.
Thank you very much. So accounting year ended 2020, which means that, watch me here, which means that they are done with 2019. Is that not the case?
Yes, sir.
They are also done with 2020. Is that not the case?
Yes, sir.
So they are yet to, which year are they yet to do with?
21 to
Up to
25.
2025. Is that not the case?
Yes, sir.
So these ones are what they are forecasted. That's expected cash flow. So the moment you see this one, it means the business valuation method. What do you expect? What are the expectations?
Since they are forecasting,
No, what you've seen the forecasting, all right. So the moment you see the forecasting, it means in your business valuation, do you some one of the method that covers this forecasting is what? That's all that I want to know.
is it not uh, discounted cash flow?
Discounted cash flow method will come. Good.
Yes, sir.
Now, have you seen that point 7 will not be relevant? Have you seen
Sure.
it? It will not,
Sure.
but you see they brought it just to confuse you.
Yes.
Point 1 is what? It's a historical profit that they've made over the years. And after that, they've also given you what? So if you're not careful, you go and use this one and you'll be wrong. And they've also given you
Sure.
what? The forecasting for previous years and expected years. Or the year that they done was 2020. They've given you the table. So if you're not careful, also, you'll start from what 2019, which is historical, 2020, which is also historical. Rather, so the last time when I was sitting, I was talking about discounted cash flow method. I said that
Yeah, you
you
explain
always
it.
look at what the future cash flows. Are we okay?
Yes, sir.
Good. Now let's look at also profit after tax and depreciation. Have you seen it? And there's also a depreciation. What did I say about that? You asked the question, and I told you
Yes.
that we will deal with that matter. What do you think we will do? What do you think will happen?
I could see from the top that we have profit after tax and depreciation. And
Yes.
then there's also a depreciation.
So what do we do? What do we do?
So from what we learned the other time,
Yeah.
it means we are going to assume we have profit after tax.
Yes.
Then we are going to add depreciation.
Absolutely. We have when there's a profit after depreciation and tax. Depreciation is not what in the cash flow.
Cash.
In the cash flow calculation, depreciation is not actual or direct activity that affected the
Generate cash.
business profit. For that reason, when they did that, you need to add it to give you
Okay.
what the fair value of what of your cash flow. Are you with me? So when you look at this
Yes.
one, they've deducted the depreciation. You need to add it back.
Okay.
Are you with me? Okay.
Okay.
But be careful. Sometimes they can also say profit before depreciation. What do you do?
If it's profit before the, if here we are adding, then before then you have to subtract before we get
You have to
profit.
do what?
We have to subtract.
No. When there's a profit before depreciation, you have to subtract.
Because profit after tax, we add.
Yeah, profit after no, it's not about tax. The interest matter here is depreciation. It's not about tax.
Oh, okay. Okay.
You understand? It's not about
Okay.
tax. It's
Yes.
about depreciation.
Okay.
Uh-huh. So whenever there's a depreciation, you look at where depreciation was deducted. If it's deducted, you need to go and add it back.
Okay.
You understand? But if it is not deducted, what do you do?
If it's not deducted, then you have to deduct.
You have to do what?
You have to take it out.
No, you have to leave it. Take it out again. They didn't deduct it. So what do? You leave it like that.
Oh, so okay. They didn't work on it, so we just have to leave it
Do you understand?
because because it has no effect.
Yeah, it has no effect. So when you say profit before depreciation, it means depreciation is not deducted. So you leave it like that.
Thank you.
Okay, let's go. Let's look at 9. Now they've given you price earning ratio and dividend yield quoted companies in Aboto industry. So here they are telling you that in the industry where Aboto is operating, price earning ratio is 8, and what? And dividend yield is 4%. Do you understand? So you take note
Yes.
of that, you underline it because you use it. Now, the net assets of Aboko Limited as of 2019 is 21,000. You understand? You be careful of these
Yes.
things. Sometimes they will bring these things to confuse you. Now, the cost of capital is 20%. This cost of capital,
that is key.
the reason why they brought this one is because of the discounted cash flow. The reason why you see this. Okay.
Okay.
And now they have what? Investing in unlisted company about 20% more riskier than investing in listed company. So what does 20% represent?
It means we are going to use that one as the risk factor.
Absolutely. So that's marketability what? Risk. Is that not the case? Now when you look at it,
Yes,
it
sir.
says that you should find what? Net assets, PE ratio, dividend yield, and discounted cash flow. Let's move. Okay, so we are here. So we have a business valuation of Aboto Limited. Can you say it?
Yes, sir.
All right, so let's move. So you have it there already. the caption. You write it. You write a caption, then you underline it. Now one. They said we should find what place
Net asset, sir.
net asset. All right. So the net asset. What is the formula for net asset?
Total asset
Okay.
minus liability
Okay. So he said it's what?
plus.
I'm coming over. He said
Okay,
it
sir.
is net asset is equal to what? Total asset minus what? Minus what?
Total asset minus total liability.
Okay. So I usually want to put it in the bracket. Total
Thank you.
liability plus what? Plus preference what?
Preference share.
Shares. Then you divide it by what?
Either equity shares or
Equity
number
shares.
of shares.
Okay. All right. So let's move. So let's look at our net assets. So please go into your what? Go into your table and let's list our net assets that we have. First asset we have is called what?
The first asset we have in our table is patent.
Patent. All right, then you bring your
Yes,
patent
sir.
here. So here I'll put here workings. All right. All right. So let us go into the question and then see the patent. What is the total value of patent in the question?
The total value in the financial statement is 40,000.
40,000, right? Now, have you seen that 40,000? Please, have you seen that 40,000?
Yes,
Hello?
sir.
Now, that
Yes, sir. I've
40,000,
seen it, sir.
good. So that 40,000 go into the what? Additional information. Did the additional information say anything about the patent? Go into it.
Yes,
What?
we were told it should be indefinitely.
It should be what? It should be indefinite. Please, have you seen it?
Yes, I saw it. They said that number 5,
Yeah.
the patent represents a right to sell a special product.
Yeah.
This product is expected to generate cash flow of 2,000 per annum indefinitely.
Okay. All right. Thank you very much. So have you seen it? Watch here. When you have indefinite, watch here. When we have indefinite cash flow, indefinite cash flow, indefinite cash flow formula is this. It's what? Cash flow over rate. Are you with me?
Yes, sir.
Good. So when you look at the question, they've given you that now the whatever the what the patent is bringing now is what? It's indefinite. Are you with me? So if it is indefinite, then the formula is going to be what? The cash flow, they say every year it brings how much?
2,000, sir.
2,000 divided by what?
The rate.
The rate. How much is the rate?
The rate, we are given the rate of 20%.
Come again, sir.
20%, sir.
Okay,
20%.
good. So the 20%, where did you get the 20% from?
That is note note 11.
Thank you very much.
Note
So,
11.
so the cost of capital, right? So what do you have here?
2,000 divided by I have 10,000,
Thank
sir.
you very much. 10,000. We are done with patent. Next one is what?
Next asset is
The next
property,
one is
plant, and
what?
equipment. Property, plant, and equipment.
Thank you very much. That's PPE. So you will write it in full in your question, right? Now, check.
Okay, sir.
Go into the question. What is the what? What is the what was the original value of PPE? How much was it?
Original value of PPE is given as 236,000.
Two what?
236,000.
Thank you very much. And now, check the question. Check the question. Well, is there any valuation?
Yes, we were told in note 2,
We were told
an
what?
independent, in note 2,
Yes.
an independent valuer estimated the fair value of PPE at 500,000.
Thank you very much. So that is what you are going to use here. Are you with me? How much is that?
Okay,
500,000.
500,000.
Then you ignore the original value. Are you with me? At
Okay,
all
sir.
time, the valued, the valued, the revalued amount comes here. Are you with me?
Okay, okay, sir.
Now, original value was how much? Let me show you this. Original value was what? How much?
236,000.
236,000, right?
Yes, sir.
And the current value is what? 500,000.
500,000.
Are you saying this? So clearly, there would have been what? There would have been revaluation gain, right?
Yes, sir.
But because I watch it, because when we are doing valuation, when we are doing business valuation, any revaluation gain goes to where? OCI, other comprehensive
OCI.
income.
Yes, sir.
Right now, this so this value will not affect the profit and loss account. Do you understand? It will not
Okay, sir.
affect profit and loss account. In fact, any net asset valuation has nothing to do with what? Any what do you call it? A fixed asset has nothing to do with valuation, has nothing to do with profit and loss account. Do you understand? In business valuation. So whether there's a revaluation
Okay.
gain or loss, it has nothing to do with profit and loss because any revaluation gain or loss will go to OCI. Are you with me? Unless
Yes, sir.
that fixed asset is what? It's an investment what asset. That's IFRS 9. Other than that, all the physical assets, whether gain or loss, has nothing to do with profit and loss account because they will go to what? OCI. So what if we treat it as IAS 16, it has no effect in our profit and loss account. The reason why we just ignore the revaluation gain or loss of that. Do you understand? So
Okay, sir.
whatever the new value of that asset is, you will bring it here. Then you ignore whether there's a gain or loss on that. Are you with me?
Okay, sir.
No, are you having problem? Let me know.
No, sir. No, sir. I'm okay.
Thank you very much. Good. Now, after the valuer did the valuation of PP and had 500,000, what is the charges? He said they are charging. He's taking what a charge on that, right?
Yes, sir.
So charges. What is the charges? How much?
2%.
Aha. So he said 2% of what of the valued amount. Is that not what they said?
Yes, 2%
Aha.
valuation charge of 2%
So
have
2%.
not been
So you charge 2%.
agreed.
of what? Of the asset, the value of the asset that you did value, right?
Okay.
Are you with me? Please, are you with me?
Yes, sir.
But
Yes, sir.
read it again. You have it. What did he say?
It's
Valuation
saying
charges of
that
2% have not been
valuation
accrued
charges of 2% have not been accrued
in the above
for
account.
in the above account.
You understand? So it means it has not been effected, right? The valuation charges have
Okay.
not been effected. Are you with me? So you need to
Okay,
charge it
sir.
and what? And calculate it. And remember, in most cases, valuations charges are what are calculated on the what? On the value of what? On the value of what? Of that particular asset that you value. Are you with me? The reason why I'm charging
Okay.
the 2% on
Okay.
500,000. Do you get it? Do you get it?
Okay, sir.
Uh-huh.
Yes,
So
sir.
so whenever there's what, whenever somebody, assuming I ask you to come and do the valuation for me on my assets, how much is your asset value? Maybe 10 million. So the charges, the person who arrange that what maybe 1% of what of the value of your assets that the person has what has given. Are you with me? Uh-huh.
Yes, sir.
All right. So the reason why, so when you do the math, what do you have?
10,000, sir.
Now 10,000. This 10,000 is going to be a what? An expenses.
Yes, sir. Thank you.
You understand? It's going to be an
Yes,
what?
it's
An
right.
expense, and these charges will what? It will pass through what?
P&L.
Thank you very much. Now the next one is what?
Next one we are done with the
Let
non-current assets. We
Okay.
come
Let's
to
go to current.
inventory. Inventory.
Okay, inventory. All right. So check the inventory. What did they say?
Inventories. From the question,
In the additional information, what did they say?
in additional information, inventory, that is note 3.
Okay. They said what? There's what? There's an obsolete
The
what? Items of 5,000. Is that not the case?
inventory include
Have you seen it? Please, have you seen it?
absolute items
Uh-huh. So what do we do?
worth
How do you go?
5,000. There's
Uh-huh.
an obsolete.
Uh-huh. So
Yes, like bar,
are you here? Hello? Can you hear me?
yes, I'm with you, sir.
Okay, good. So all you have to go and do is
Sir, I'm
that.
with you.
Good. Go into the question.
Yes, sir.
Go into the question.
Sir,
what
I
is
can
the
hear you loud and clear.
Okay, so what is the inventory? In the balance sheet, what is the inventory? How much is the inventory in the financial position?
26,525. 20. In the financial position, it is 20,520.
Then you will less the what? The one they were advised by the auditor. They should, which is the obsolete. How much is the obsolete?
The
So
absolute
when you
value
less,
is
what do we have?
5,000 Ghana cedis.
When you less, what do we have?
Come in, sir. 21,520.
Thank you. The next one is what? The next one is what?
Next one is receivables, sir.
Receivables.
Receivables.
Now, the receivable, what did they say in the what? In the question?
Receivables. We were told in the question that receivables include an amount of 12,000 resulting from the bankruptcy of a major customer. Auto Limited is not likely to realize any amount from this, but the director have refused to make any provision.
It means it is irrecoverable amount. Is that not the case?
Yes, sir.
Then you will pick. So what is the receivables? What do you have it in the balance sheet?
It's 25,800.
Okay. You less the irrecoverable, which is 12,000. What do you have?
So when you less 12,000 from 26, I'm coming. 5, 2, 14,520, sir.
13. What you said what?
14, 1 4.
Hey, 25, 800 minus 12,000. Me, I can't, I don't get it to me here. I can do it here. I have 13,800. Because 1 minus 2 is 1. 2 minus 5 is
26,
3.
26,
Huh?
5,
Come again.
20 minus
25,800 minus
12,000.
12,000. It's
So it's
13,000.
26. So, oh, yeah, yeah. Sir, you are right. You are right.
Yeah.
25.
So let's
25.
move. The next one is
Sir,
what?
you are right.
Okay. The next one is what?
13,800.
Yeah. So the next one is what?
The next one is bank and cash. Bank and cash.
Okay. So that one, it has the cash and bank will nothing will happen to it. In valuation, cash and bank, if you have it there, nothing will affect it. Do you understand? Do you understand? When you're doing business valuation, cash or your bank, they are money you already have it. So it has nothing will affect it. Are you with me?
Need an explanation. Okay, sir.
Come
Okay,
again.
sir. Sir, I am okay.
Do you understand the explanation that I made?
Yes, sir.
Okay. Now let's move to the next one. Is what?
That's what. Then we are going to the liabilities.
Yes.
Equity.
Equity. Is equity
Yes,
a
sir.
liability?
We have 20%
So
irrecoverable preferential
20%,
share.
20% what?
Irredeemable
You don't know what?
preferential.
We'll come to that one. Skip that one. I'll push it somewhere. I want to also finish with all the liabilities before we come to preferences. Where you are is equity. I want us to go to liabilities.
Share. We have retained earnings.
Oh, go to liabilities, eh?
Okay.
Go to
Then
liabilities.
non-current liability.
Yeah.
Non-current liability.
Okay.
20% debenture.
20% debenture.
Yes, sir.
So what did they say about debenture?
We were told in the footnote that
Go to item 6.
Note 6.
Yeah,
The discounted present value of future cash payment in respect of the debenture is 20,000.
good. So yeah, how much do you have it in the what? In the question. How much do you have there?
That is 13,000, sir.
Good. So here they foresee that the expected liability for the what debenture would be 20,000 instead of what 13,000. Is that not the case?
13,000.
You understand?
Yes, sir.
Okay, so
Yes, sir.
debenture is what is a liability, so you put it in brackets. How much? 20,000. Are you following? Okay. The next one is what?
Yes, sir. Trade creditors.
Trade creditors. Okay. What did they say about trade creditors? Trade creditors, how much?
11,600.
They didn't say anything. They don't have notes in the note. They didn't have anything about that, right? In the
Yes.
note, there's nothing like trade creditors issue, right? Okay. Let's go.
Yes,
What
sir.
next?
The next one is accrued charges.
Accrued charges. Accrued charges. So we don't have anything in the additional information. So how much is that one too?
In the note, that
How
is
much? How much?
1,600.
1,600. What again?
We are done.
We are done. Good. Now let's move
Yes,
to
sir.
the go to your equity.
Preferential.
Do you have any preference shares there? Do you have preference shares there?
Yes. Irredeemable
So
preference
preference
shares.
shares, right? So how much is the preference shares?
The preference share in the question, 35,000.
Good. They didn't give any notes about that in what in the
Yes.
35,000. So that one to you less it. That's all. So you add everything. Do you have it now?
Yeah, so I'm to calculate them.
Yeah, add
The,
them.
the 35, the 35, are you going to subtract it?
Oh, those in the bracket are deduction. Those who are outside bracket are additions. So you should
Uh,
know how to do your calculation, right?
so I know. So you say you go down. Let me see something.
Because look
Down.
at because look at the formula.
So down. You go down.
I know, but look at I want to. You are talking about preference shares. Look at the formula.
Yes.
You are adding the preference shares to all the liability. Then you deduct it from the asset. That's the meaning.
Okay. Okay. Thank you.
So yeah, the preference share you see there, it's more like you are doing what do you call it? You are adding. If you like, you can add all those in the bracket. Then you add all those outside the bracket. Then you find the difference. It's the same thing.
Thank you. Thank you.
So let's go do the additions.
Okay. Sir, 400 and
I'm listening.
474,000
Have patience. 4, 7.
for
I'm listening. Oh.
32320.
Good. So this becomes your what? Your business value or total
Yes.
value. So this becomes your total value. All right.
Now value of a share.
Yes, the total value of the business. So now let's look at the equity shares. Now, what is the equity shares?
Equity shares you have is 200,000.
Check in the question. In the question, what is the total equity shares?
The 200,000, sir.
Okay, so 200,000. So 200,000 is the what? Is the obviously so 200,000 is the total equity of the company, but it is not what here. It is not in what in shares, but they are what in value. You understand? Do you understand?
Okay.
So how do you convert
Yes,
it
sir.
into what? How do you convert it into
Yes,
shares?
sir.
How do you convert it into shares? So here you have what? Um, the equity shares. So you have it here. Equity in value is 200,000. So equity capital is 200,000. And then when you look into the question, they said that what share price is how much? 100. Have you seen it?
Yes, sir. Share price.
Check it first. Uh,
Sure. Number one.
you understand? So here you can now have your what? Your number of what? Number of shares will be how much? You will have what? Divided by what? By the number of shares. What do you have?
Then you have
2,000 shares.
2,000 shares.
All right. So here you have it. Now you will have your what? Your value per unit. Value per what? Value per shares. Will be what? Will be 4, 7, 4, three,
Sir, it is 200,000 divided by 100. Ah,
yes,
okay.
when you divide it, give it
Okay.
2,000. All divided
That's
by
right.
what? By the 2,000 shares you have. So what do you have?
I'm going to draw it now. 237.16.
Thank you very much. 237.16. That's all. So we are done with what? With net
The net
asset.
asset.
So let's go to the second one. The second one is what?
Price earning
Okay.
share ratio.
Price ratio. Okay. So please give me the formula.
That will give me market price per share over earning per share.
You said what?
Market price
Per share
over earning per share.
over earning per share. So that gives you what in eventually?
So we are looking for the earning. So market price equal
So that gives you what? Market price per share is equal to what?
market price per share equal to price earning ratio
Okay, price earning ratio
multiplied by earning
times
per share.
earning per share. Thank you. So now when you are confronted like this, then you need to what? You need to find them one by one. So whichever one we want to
Yes, sir.
find first. Now let us look for our PE ratio first.
Okay.
Now PE ratio, because we are unlisted, we cannot know. So we need to compare ourselves to the listed company. Are you with me? So here
Yes, sir.
now we need to compare ourselves to the industry. So you will have what? So you will have what? Abutu here, and you have what? Industry. Now, in the question, they said Abutu, we don't know, right? But the industry, we know industry. How much is
Yes,
the industry? Go
that is
to
unlisted.
the industry is how much? The industry is how much? Look at
8.
.9. Have you seen it? Have you seen it?
8. Yes.
Okay, so
Yes, sir.
the industry 8.
8.
Now, they also gave you marketability risk. Marketability risk in the question is how much?
20%, sir.
Thank you. So what do you do? I've taught you all this. What do you do?
This you discount, you write it down.
So what do you do?
It will be 100 minus 20.
Okay, so you have 100 minus what? 20. That gives you how much?
80%.
So that gives you 80%. So this 80%, what do you do with the 80%?
You multiply it by the
Thank you
8.
very much. So you have what? Your 8 multiplied by 80%. What do you have?
So 8 times point 8. 6.4.
Thank you very much. So you have what? 6.4. Now, now we can know our PE ratio for Abutu to what? 6.4. Right? Good.
Yes, sir.
So we are done here. So let's look at what?
The earning per
Earning
share.
per share. Now the earning per share formula, I said it is what? Profit,
The earning per share formula.
profit after what? After tax.
Profit after tax.
Less what? Less any preference what? Dividend. You remember?
Yes, sir.
All divided by what? All
By
divided
the
by
equity.
equity share or number of what? Number of shares. Okay, so let's go. Let's look for our earning per share. Let's go look for our earning per share. So our earning per share, what are we looking at? So you have what? You have let's look at our earnings.
Profit after.
Let's look for our earnings. Earnings. So let's look at our profit. Do we have profit? Check in the person. Check our profit in the person. Go to the balance sheet, statement of financial or profit and loss account. Sorry. Go to profit and loss account.
Profit is 41.
Profit after tax. Oh,
Uh,
yes. It's what?
Profit after tax 41,500.
41,500, right?
Yes, sir.
Now, come here. Go to the adjustment that you made in the what? In the net asset. Are there
Okay.
any item that will affect the profit and loss account? You check it. You understand? Are you with me?
Yes, sir.
So your first point of call, you go to the adjustment that you made under the net asset. If there's any item that will affect your profit at the end of the year, then you go there, right? Now, when you look at patent, patent is statement of financial position item. It doesn't go to profit and loss. It has nothing to do with
P&L.
profit and loss account, right? So nothing,
Yes, sir.
it has no effect. Come to PPE. PPE2 is what? Sale of financial position item. It has nothing to do with what? P&L, you move. Now, check charges. There's a charges of work done here for the company. You remember? Please, you
Yeah,
remember.
which is an expense.
And I'm saying you remember this charges.
Yes, sir.
Go. So this one will go
Yeah,
to what?
yes, sir.
So this one will go to what? This one will go to P&L,
Yeah, no.
right? Now let's look at inventory. Inventory is what? Is P&L item at the same time what? System of financial position item. You know that.
The bad debt. The bad debt.
No, I'm talking about inventory.
Okay.
Inventory.
The absolute amount.
The absolute time. You know that inventory affects your profit and loss account.
Yes.
Are you with me?
Yes, sir.
Your opening inventory or closing inventory is part of the inventory I'm talking about. It affects your P&L. So whenever there's what
Yes.
there's any adjustment to it, it will affect your P&L. Do you understand? Because you see,
Sure.
this 26,500 was a closing balance from what? From the P&L. And they were supposed to less the 5,000 and they didn't, and they closed the account. Do you understand? So when you make this
Yes, sir.
adjustment, it will affect the P&L as well. Are you with me?
Yes, sir.
Good. Now let's look at receivables. Receivables too is what? Is the P&L and the profit and loss item, right? All your credit sales,
Yes, sir.
all your credit sales are under your P&L. Do you understand? So when we come to the system of financial position, we call it what? Receivables. Are you with me? Now,
Yes, sir.
you've already closed this account with what? With this amount. And it is now clear that this one is finally what? A bad debt. So it will also affect your what? Affect your P&L, right?
Yeah, no.
Good. So
Yes,
apart
sir.
from these, what again can affect your P&L?
We don't have anything again.
Good.
Accrued charges will not
No,
go.
no, accrued charges is like what do you call it? It's like accrued charges can be what here? You have what? Creditors. Creditors will not affect your
Yeah,
it will
no.
not affect your P&L in any way. Accrued charges will also not affect your P&L anyway because they are what? They are debts you are supposed to what? To pay. Do you understand? So
Yes, sir.
if you pay, it will reduce your profit. If you don't pay, it will increase your what? Your liabilities. Is
Your
that not the case?
liability.
Aha.
Yes, sir.
So once there is no issue about accrued charges, assuming they said that, oh, part of the accrued charges is paid, then it will go to P&L. Is that not the case?
Yes, sir.
Or they say that some of the creditors has settled their what? We settle some of the creditors, it will also go to P&L to affect your purchases. So there's nothing like that. So that's it. There you go here, you come here and do your adjustment. You understand? So the first one is what? Is your what? Your charges. Your 2% charges. And it is what? 10,000, remember. And the second one is what? Inventory. Inventory, it is what? There's 5,000 absolute item of what? Inventory. And you have your
Yeah.
what? Your receivables. Your receivables. Or what? Your bad debt. Is how much? Your bad debt is how much? 12,000. That's all. So what do you have? Do the math.
Okay. Bad debt is 12,000. Okay, sir. 41,500 minus 10,000 minus 5,000 minus 12,000. Sir, 14,500.
14,500.
Yes, sir.
Good. So this is your what? This is your what? Your total
Your
earnings.
profit.
Yeah, your profit or your earnings so far as adjusted. So this counts your what?
Okay.
Your adjusted what?
Earning.
Thank you very much. Now, remember, I said that you will less any preference dividend if you have it in your what in your books. Is that not the case? So you
Yes, sir.
less what preference dividend. Now let us go into the what? Let us go into the let us go into the balance sheet. Let us go into the balance sheet. Let us go into the balance sheet. What did the balance sheet say?
The
Do we have
balance sheet.
preference shares in our balance sheet?
Yes,
Uh-huh.
irredeemable preference share.
Irredeemable preference shares. So what? How much is the irredeemable preference shares?
35,000, sir.
Thank you very much. So here you have what? 35,000. And the preference share percentage along, you see it by the side of what? Of it. Listen, what is the percentage?
20%, sir.
20%. Good. So you multiply that by what? By 20%. What do we have?
The 35 by 20. Sir, 7,000, sir.
Thank you very much. 7,000. Then you less it. What do we have?
Then it will give you 7,500.
7,500. So earning. So this becomes your what? Earnings after all the adjustments. So now you have your what? Your earnings.
Sir, let me ask this question.
Ask.
Yeah, what about the proposed dividend in the P&L?
What dividend?
Proposed dividend.
Where is it?
It's in the P&L.
PNL. Okay, watch it.
Yes. Check that one.
Proposed dividend. This proposed dividend, listen very carefully here. There's a difference between what? A preference dividend and proposed dividend. Proposed dividend. Proposed dividend are for what? Are for ordinary shareholders.
Thank you.
This
Thank
one
you.
is for ordinary shareholders. It belongs to them. Do you understand? The moment you see proposed dividend,
Thank you.
or maybe they can give maybe a percentage of dividend they will pay from what? From their profit. Do you understand? Either you see proposed dividend as given in all, or maybe they will give you maybe 60%. You understand?
Thank
Sixty
you, sir.
percent proposal. It is for ordinary shareholders. Do you understand? Preference
Sir, thank you.
shareholders, we don't
I'm
propose.
okay, sir.
Preference dividend shareholders, we don't propose. It is already what? There for them.
Established.
Automatic.
Established.
Okay. Now let's
Thank
move
you,
to
sir.
now our earnings per share will be how much? So you will have what? Our earnings per share is going to be what? Our profit over what? Our number of what? Shares. What do we have? We have our profit, which is what 5,000, 7,500, all divided by our earnings. Our number of shares is how much? 2,000. Remember? Do you remember?
Yes, sir. We calculated it.
Good. So how much is it?
I'm coming. 7,500.
Earning per share will be how much?
Sir, it's 3.75, sir.
Okay. 3 point what?
75 per share.
3.75. Okay. Hey, 3.75. Please, are you following?
Yes, sir. Therefore,
Yeah, so this becomes your what? Your earning per share. Are you cool? Please,
yes, sir.
are you cool?
Yes, sir.
Good. So this becomes your what? So you should understand these things. So when you come to the PE ratio, you should understand, you should follow the formulas, right? It's all about the formula. So you see how I tackle it. So you will come here, you'll find your formula, Then you start what do you call it? Identify the items one by one. You pick this one, you identify. You pick this one, also you identify. Are you with me? Okay. So when you
Yes,
pick,
sir.
as we did it here, now when we come to the earning per share, it's a profit after tax. Then you less any preference dividend from it. Then you divide it by the number of shares. Are you with me? Ah.
Yes,
So
sir.
so when you do that, whatever is left is for what? It's for the company or ordinary shares holders. Are you with me?
Yes, sir.
Good. So the same thing as we've done here. So yeah, you adjust all your earnings. So whatever is left, this money that is left is what will go to the what is what it is what goes what to the company. Are you with me? So what is left goes to the
Yes,
company.
sir.
Now, if you want to know the earnings per share, you divide by number of shares. The proposed dividend that you've seen over there. Do you understand? The proposed dividend you see over there is what is dividend that will go to what to the ordinary shareholders.
Ordinary
That
shareholder.
one has nothing to do with this. Are you with me? We are talking
Yes,
about
sir.
what the total earnings. So the total earnings is like what about net profit after what after tax after we deducted all the preference shares. So this thing belongs
Shares.
to what to the ordinary shareholders. If they want to pay dividend out of it, that is their problem. Do you understand? But for now,
Yes,
the
sir.
proposed dividend has nothing to do with us here. So now we've established that. So now we can now find our what our MPS
Equal
or
to
value per share to be what P times what times the earning per share. So what do we have here? You have our PE is what
6.4
6.4 times what
times
times three
3.75.
point seven five. What do you have?
24.
24. Like this.
Yes, sir.
Okay, we are done with this one too. Then let's move to the next one is what?
Dividend yield.
I'm listening, sir.
Dividend yield, sir.
Okay, so the third
Dividend
one.
yield.
So the third one is what? Dividend yield. Now, what is the formula for dividend yield? It said what?
Dividend per share over
Dividend
market
per
price per
share
share.
over what? Over MPS. Now, what did they say? So the MPS, I want to say what MPS. So the MPS equal to what? Have you forgotten?
Dividend per share over DY.
Thank you very much. So dividend per share over DY. Good. So now we have it. Now let's look for it one by one. Let's pick our dividend per share. Now, what is our dividend per share? Do you understand? What is our dividend per share?
Yes, sir.
Dividend per share is what? Dividend
Sir,
per share is what?
sir.
Yes.
I would
Yes.
like us to use
Come again.
the way you did.
Come again.
I would like us to operate. Let's operate the way you did the PE ratio.
Thank you very
Let's
much.
find the listed and unlisted first. I wanted us to follow that trend.
Okay, no. We are following it. The one that so
Uh,
we start with DPS.
well, I wanted us to start with DY
No,
so
no, no.
that we
Let's
have
start.
the
We start with DY. Okay.
so that we have the listed and
No
unlisted.
problem,
So
no
I
problem,
know
no problem,
PE
no
and
problem, sir. So you have
thank
what?
you
Your
very much.
dividend yield. So when you have your dividend yield, because the company is not listed, there's no
Thank
way
you,
we
sir.
can what? You can know the what? The dividend yield of what of the company. Do you understand? Because since the we don't know the what market price per share. So what do we do? So you'll have what? You have what? Aboto, and then you will have what? the industry.
industry.
Okay, so when you pick them, you know that the industry is how much? 4%.
4%. So
But we don't
4.
know the what? We don't know about it. So what do we do? Right? What do we do? So we have to depend on what? On the industry. In order that will help us what to find a what? Find what do you call it? The listed. Is that not the case? Okay, so what
Yes,
do we
sir.
do? What did I say you will do?
So you see, we find the marketability.
Come again, sir.
We find the marketability rate.
Okay. We find the marketability. So how do we find the marketability?
That will be the
Okay, so the marketability risk.
marketability risk is, well,
Marketability.
this is 20%.
I'm coming though. Marketability risk.
Yes,
Marketability
sir.
risk is how much? 20%.
Marketability risk is,
Right now, watch this.
yes,
Are you
sir.
saying because we are doing the division, what do we do? The adjustment is going to be what?
Because we are going to add,
Come again. Adjustment will be
we are
going to
going
be
to
what?
add.
So it will be
It's going to
upwards.
add up.
So here you will have it 100 plus what? 20. So what do we have?
120.
Okay. Okay, so here. Now you have it here. So you have what? 4% multiplied by what? What do we have, please?
I'm coming, sir.
What do we have?
There is 0.048.
Okay, so that gives you what? 4 point what?
4.8%.
8. So here you will see that our dy, now we know our dy to what? To be 4.8%. Okay, good. Now let's do our dividend per share,
Share. Thank you, sir.
right? Now, when we look at the dividend per share, let's look at the dividend per share. Now, dividend per share is what? How do we get the dividend per share? Dividend per share is what? Is total
Total, yeah.
dividend. Total dividend less any preferred dividend you have,
Total dividend declared.
all divided by what? Number of what? Shares. Total dividend declared minus preferred dividend, what by number of shares? That gives you dividend per share. Now, here, go into the question. You have what? Proposed dividend. What is the proposed dividend? So that's the total
Proposed
dividend.
dividend
So that's the total dividend for what? For the company. What? How much is it?
for that is a proposed dividend is giving me
It's how
16,000.
much? How much?
16,000, sir.
16,000. 16,000. So here, so this proposed dividend, right? So this proposed dividend is a dividend that the company has proposed to pay out. Are you with me? Okay.
Yes, sir.
So this is the proposed dividend that they've decided to pay out to. I think this proposed dividend is combination of. So when we see, let me define this properly for you. Let me define this one properly for you. I think proposed dividend, that is a fact. Proposed dividend consists of what? ordinary dividend, and preference dividend holders, preference shareholders. Proposed dividend consists of these two people. It consists of these two people. Okay. So here in a question you have what? Proposed dividend. Proposed dividend is what? 16,000. And they have what? When we are looking for dividend per share, our interest is for ordinary shareholders. Do you understand? So when we are looking for
Yes, sir.
dividend per share, we are talking about what? Ordinary shareholders dividend. Ordinary shareholders. So
Thank
which
you.
is what? 16,000. Then you will less if you have any preference dividend shares in the personal. So preference dividend. When we did the preference dividend, how much did we get? It was how much?
Preference dividend
35,000 multiplied by 20%. We had 7,000. Then you
750.
7,000. You will less it. So whatever is left is for what? It's for only ordinary shareholders. What do we have?
Thank you.
What do we have?
So I'm coming. Oh.
Come again.
I'm coming.
Oh,
16,000.
it will be 9,000, I guess.
And, yes, sir.
Uh-huh. So this is what
Then
for
9,000.
ordinary shareholders. Take note of that. Now we have what? What is the number of what? Number of what? Shares. That's how much? 2,000. So here, dividend per share will be what?
Two.
Will be dividend per share will be what? Ordinary
Yes, sir.
shareholder dividend, all divided by what? Number of what? Shares. Which is what? 5,000 divided by 2,000. What do you have? What do you have? What do we have? Hello? Hello?
4.5, sir.
4.5.
4.5. Okay. Now we are done. So here,
Sir,
once you have this,
4.5.
so once you have this one, then you can find your what? Your MPS is equal to what? Dividend per share, all divided by what? DY. Now dividend per share is how much? 4.5, all divided by dividend yield is how much? 4.8%. Please, what do we have?
0.937.
0. This one, this is percentage, so convert it into decimals.
Ah, okay, 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 okay. Sorry.
But your answer is correct.
Sorry.
No, your answer is correct. It will still give
Yeah,
you.
I'm coming, sir.
Yeah.
You let me put it in there. 93.
93.
0.75.
Good. We are done with this one. Let's go to fourth one. Okay. The fourth one is what?
That is discounted cash flow.
Discounted cash flow. Okay. So what's the formula for discounted cash flow? Come again.
Discounted cash flow. That is where we are now.
Come again.
So, I said we're on discounted cash flow.
So what's the formula? Discounted cash flow
Okay. That is discounted
divided
cash
by what?
flow over.
Equity shares.
Yes, sir.
So here, this is how we go about it. So here, please, we will have our years, the profits we have. Remember, in this question, you see that they have deducted depreciation. You remember?
Yes, sir. Already.
Then you add depreciation back. Then you have your what? Before you get your what? Your cash flow. Then you can have your what? Your DCF. They're giving you what? 20% capital. Then you have before you get your what? Your present value. This is how it looks like. Now check your question. I said that the cash flow are what? They are expected income or profit for the company, right? So which year will
Yes,
you
sir.
start if your accounting year ends in 2020?
So we go one
Come again.
step down.
You go what? Hello?
21, 22,
Okay.
23. One step down. One step down.
So you go to 21.
Then you add back depreciation. When you add back depreciation, what do you have for 2021?
I'm coming here. Give me some small drive. I don't want to mix any of your words. Your words are sacrosanct. So let me get them done. The first one is 55,000.
Okay, so the DCF. Do you know how to calculate discount factors?
You teach me your own. Oh.
Come
Maybe
again.
your own will be shorter.
Come
Teach
again.
me your own. Let me know. Let me learn from you.
Let you do what?
Let me learn from you. Your methods are simple.
No, so this is a method. This is a method. 1 plus r to the power negative n, right?
Yes,
I,
sir.
so you just power it. So year one, you put 1 plus the interest, the the cost of capital is 20%. So you have 0.2 to the power of negative. Year one is 1. Then you calculate year 2, it will be negative to the power of negative 2 to the last year. Do you understand?
So here, are we starting from one street, or
You said what?
are we starting from one street?
1.
The 21 will be one, or we have to do the
How
one.
do you think we calculate it?
I thought maybe you do this thing first.
Come again, sir.
You do the formula work first for number one.
You said what?
You see, like the first one,
Yeah.
I know R is 20.
The
So
R is the interest rate.
exactly. So divided by 1.2. So the first one is 0.833.
Yeah.
And I'm asking, are we not going to start with just one? Because that is
Yes,
the
yes,
initial.
yes. Because
It's a question
watch
I'm
here.
asking.
Watch here. You know, you are one who is coming to do the evaluation of a business, right?
Yes,
And they've given you all this information that
yes,
okay, calculate the what? The expected cash flow of the business. You are in 2020. So calculate the expected cash
yes,
flow of the business for the ensuing years to come, right? Okay.
yes,
If you
sir.
are in 2020, 2021 is how many years? You are 2020. 2021 is how many years?
2020, 2021. That will be two
It's
years.
what? Come again. I can't hear you.
2020 is 1 year.
It's 1 year.
2020 is 1 year.
2021 is 1 year.
2020,
Uh-huh.
yes.
2022 is 2 years because you are in 2020. 2020, your accounting year ends in 2020,
Yes.
and the business is being valued. You understand? Using cash flow.
Yes, sir.
So the year you are doing the valuation, compare that to the ensuing years. You understand? So if
Okay,
you are
sir.
2020, 2021 is year one, 2022 year two. So what do you have 2021? What is the discount factor?
I had 0.833.
So don't clean it.
I'll divide it by
No. You multiply.
1 point.
Hey, you multiply by 55,000, please.
Before, no, I wanted to get this ones first.
Okay, do it.
Uh-huh. The next one is 0.6944.
0.69. I leave it in 3 decimal place, please.
Okay, sir.
The next one is what?
The next one is 0.578.
Okay, the next one is what? Make it 9. This one,
Okay,
the next one is what?
coming, sir. 0.482.
Okay, the next one is what?
Coming. 0.401.
Good. No, you make it 2.
Okay.
Living it. So you multiply 80,000 by 0.402. How much do you have?
80,000. Okay. Sir, 30, 32,160.
Let's move. Let's move. The next one, 2024.
To the top, 70,000
Come again.
times 0.82. 33,740.
The next one,
The next one, 65,000 times 0.5. 570. 41,640.
that's what?
60. So let me start from the top.
Okay.
45,815.
8 what?
Next one, 4815.
81.
Five, yes.
Like this.
Yes, sir, you are right.
Okay, go. Go on.
Next one, 41,640. Next one, 37,570.
Ah, 41,600 and what?
640.
No, no, second one, second one.
41,640.
Oh,
41,640.
the last one.
570.
What? I can't
Five
hear you.
seven zero.
Again.
37.
37, 5, 37,
Yeah,
570. 555
like this.
70. Thank you.
Yes,
Okay.
sir.
Oh, I have calculate and okay. Let me confirm some of the
Pepper big one.
figures.
Pepper big one. 190
190
990.
990. Like this.
Yes, sir.
Okay, so you can have your what? Value per share is what? 190 990. What do you have?
95.49.
Okay, so that is it. Okay, let's go to the next one. The next one is business valuation of the next one is which company? Anidaso. Let's look at the Anidaso Limited. This one, because we've done this one, we will not belabor the point. Let me look at that. You can see that person, right?
Yes, sir.
Ah. So when you look at the Anidaso, that one to follow their unlisted company. Look at the state of financial position and then profit and loss account. The accounting year ends in 2019, and we have other additional information here. Now, Anidaso is the what? Is the company that is. Have you seen that? Anidaso is the company that is what?
He wanted to be listed.
Yes, it's unlisted company. So follow me
Yes.
here, small. Now, check the additional information. Have you seen the additional information?
Yes, sir.
Now we have 20% preference share being 10,000. We have ordinary shares, which is what 20 pesos per share. Have you seen it? Okay.
Yes, sir.
Now, when you follow it, also you realize that a review of the development expenditure indicate that only 50% of it is worthwhile. Okay. So that one too is part of what? Of the information that you should what you should know. And there's also independent value the what the asset of the company. You should take note of all of them. Yeah. Now we have also a forecast of next 5 years. And they started from 2020 to 2024. Have you seen it? Now they said profit before tax. Please have you seen it?
Yes, sir.
Profit before tax. Have you seen it?
Yes, sir.
Now watch here. They said that the estimated profit before tax are arrived at before charging the estimated depreciation. What does it tell you?
Before charging, it means they've not charged it. Oh.
Thank you very much. Your patent. They said that the patent in the financial position represents a license to produce an improved variety of products and expected to generate pre-tax profit of 10,000 per year for the next 5 years. What is this one? This one is what?
This one, the next 5 years, I think annuity. Is that not it?
It's supposed to generate
Profit.
profit, pre-tax profit for what? For 10 years,
5 years.
5 years. So have you seen that this one is definite?
Yes.
Do you understand?
Yes, sir.
So it means every year it will generate 10,000. Every year it will generate 10,000. In accounting, we said that any expected revenue or liability are what? They are discounted to the what? To the present value. Do you understand?
Yes, sir.
So now, if you have revenue to be generated 10,000 every year, 10,000 for 5 years, it means we need to discount this revenue for 5 years. Are you with me?
Yes, sir.
Uh,
Yes, sir.
Good. Now, watch here. They have given you what do you call it? Abiola. Abiola is the industry company. So they are using the Abiola company as what? As a benchmark. So that it will help you to calculate certain values for what? For Anidaso. Do you understand?
Yes,
Okay.
sir.
So that is it about this question. Are you with me?
Yes,
Now
sir.
let me share my then we go in. So here, let's start. So the first one is what? They say you should find what?
The first one, net assets, sir.
Net asset. Net asset method. And the formula for net asset is what? So this one you should do more talking there. I'm listening.
Yes. So we are finding the net asset. So
So the formula
we
is
go
what?
to the net asset equal to total asset.
No, I'm saying the formula for net asset is what?
Net asset, total asset
Eh,
minus total liability plus
Total what?
total asset
Minus what?
Total liability plus
All right. So all divided by what?
equity share.
Thank you. Now let's go in straight away. Then you what? You will list your what? Your net assets here. Now here I will put my workings here as well, if any. Now please go into your what? Your balance sheet. Which item do you see first? Which item do you see first?
Yeah, boss, I'm with you.
Yeah, which item do you see first in your balance sheet?
The balance sheet here, I'm seeing that of
You do what?
development expenditure.
Uh,
Development expenditure.
Development expenditure.
Development expenditure.
Yes, sir.
Development expenditure. Go into the additional information. What did they say?
With the development expenditure, we are being told in the additional information that a review of the development expenditure indicates that only 50% of it is worthwhile.
So it means part of it is what?
Fifty
It's not.
percent
It's not.
cannot be
It's not.
retrieved.
It's not
But then
worthy, right? Okay. So part of it is
it's
what?
not retrievable.
So part of it is impaired. So how much is it? How much is it?
Development expenditure is in the financial statement is 13,050. 13,050. 13,050.
And they said that what? Part of it, which is how much? What's the percentage?
50%.
You calculate. What do we have?
6,525.
All right. The next item is what?
The next item in the
No,
financial
stand there, stand there. Let
statement
me ask you. A development expenditure P&L item?
no,
Good. Let's move. The next
no,
one is what?
patent, patent,
Patent.
patent.
And what did they say about patent? They said that the patent that you see in the balance sheet is not what you are going to use. But they said that the patent is going to generate revenue for the next what? 5 years. 10,000, ten
5
thousand, ten
years, sir.
thousand. You remember?
Yes, sir.
Good. So if you remember, there's two ways that you can what you can calculate this, right?
Thank you.
First one is
Thank
this.
you.
First one is this. You use what? 1 plus r to the power of negative, or you use what? Uh, this method. What is 1 minus 1 plus r to the power of negative n all divided by r. You understand? Good. Now let us use the
Yes,
first
sir.
one. They said that every year for every year they what they will get 10,000. So you pick yes,
10,000.
you will pick your cash flow, you pick your DCF, you pick your present value. So 1, 2, 3, 4, 5. So year one 10,000, year two 10,000, year three 10,000, year four 10,000, year five 10,000. And then we should discount it to expected earning. Once it's expected inflow, you need to discount to the present value. Now, in the question, did they give us cost of capital in the question?
Yes, sir.
How much is the cost of capital?
10%,
10%.
sir.
Okay. So here, this is what? 10%. Okay. So if so, what do you call it? Uh, 1 plus 0.1 to the power of what? -1 is how much?
1 plus 0.1. Discounting factor. Okay.
I don't know.
1 divided
Have you heard it?
by 0.909. 0.909.
0.909, right? Year two is how much?
Yes, sir. Year 2. 0.826.
0.826. Year three,
Year 3. 0.751.
0.751. Let's go.
0.683.
0.6.
83.
Uh-huh. Year five.
Yeah, 5. 0.6.
choose 1.
Good. Let us do the multiplication.
0, 10,000. Say it's 10,000.
Yes.
Okay. So it is 1990.
Which one?
First one, 1990.
Year 1 or year 5?
Year 1, 1990.
Okay. Year 2?
8260. 8260.
Third year,
I'm coming, sir.
75.
7510.
Uh-huh. When you add them, what do you have?
830. I'm coming over. 37,900.
Like this.
Yes, sir.
Yeah. Now, I've been saying this one will take you long time, right? I've been saying the process. Now, what is another option? The option is that you can use this.
Yes, sir.
1 minus into bracket 1 plus. The rate is how much? 0.1 into bracket the power of what? How many years? 5 years, right? All divided by what? The interest rate, which is what? 0.1, right? Then you multiply by what? By the 10,000.
Yes, sir.
You understand? So first,
Okay.
find this one. What do you get there? What is the present value? What is the discount? What is the factor?
Okay.
So first, find do 1 minus into bracket 1 plus 0.1 to the power of negative what? 5. Then you divide everything by what? 0.1.
Sir, the
Yeah.
same. I'm getting the same. That is
I'm saying give me the factor.
7,907. The
So,
factor up there.
so when you did, what do you get?
37,907.
It's because of the decimal. That's why you see this. So you
The
see,
decimals. Yes.
you see, when the cash flow is what constant,
Constant.
it's
Yes,
better
sir.
to use this one so that it will be easy for you. You understand? But if they are not constant, maybe each year the cash flow is different, then you use the second one will not be possible. You use this one. You understand?
Yes, sir.
But if the cash flow is constant, then you use this one method. So you arrive at the same answer. You understand? So that is the whole thing here. You understand? So that's all that they are working out here for you. That it will be 1 minus 1 plus what? Plus 0.1, right?
Yes, sir.
To the power of what? Negative 5, all divided by 0.1, right? You multiply by what? By 10,000. And that's what you said, what? 37, 9, 0.
907.
Okay, you see. So it means this is what you are going to generate at the end of what? The 5
The
years.
5 years.
Okay, so the next item is what?
Next item.
Come again.
Inventory, sir.
Inventory. Okay, so in
Yes,
the
sorry.
question, they say anything about inventory?
No, sir. We have PPE. Sorry,
Come again.
PPE, sir.
Okay, PPE. In the question, did they say anything about PPE?
Yes, sir.
Okay, what did they say?
PPE. An independent valuer has placed values on some of the assets of a
Okay,
data
so
limited.
the PPE, so now they revalue the asset. Plant and property, plant and equipment is now how much?
Now, property, plant, and equipment is now 11,111,000.
So 111,000. Yeah, you see, I told you that whenever there's a valuation of an asset, the one that you have in the what? In the balance
The note.
sheet, in the balance sheet ceases to what? To be used for anything. Are you with me?
Yes, sir. Yes, sir.
Because it has no effect. in the what? In the valuation. Are you with me? Because it has no
Yes,
effect
sir.
in what? In the statement of financial in the profit and loss account, and it has no effect also in the balance sheet. So the new value is what you use. The next item is what?
Inventory, sir.
Inventory.
Yes, sir.
Is inventory also valued?
Yes.
They say how much is the value now?
16,200, sir.
Aha. So that's now the inventory value 16,200, right?
Yes, sir.
Okay. But they didn't say anything about inventory. What do you call it?
Trade receivable is there.
Come again.
And then they didn't say anything about inventory.
Okay. So what again?
Trade receivable, sir.
So receivable. How much?
10,000, sir.
Okay, 10,000. What again?
Cash and bank. He said
Cash and
the
back
same
because
value.
inventory. Did they say anything about inventory?
Inventory.
Eh?
No, I'm not seeing anything. No,
Okay, so cash and bank will
no.
remain the same. How much?
Cash and bank is giving me 5,944.
Okay. What again?
Now we move to liability, sir.
Okay. Let's go to liability.
Uh, Non-current liability, debenture, 10%.
We are talking about let's go to liabilities, please.
Yes.
Let's go. Let's
From
go.
the question, then let's, sir, are we going to arrange it the way the
No, no,
question
no. You just go to
is
liability
depicted?
straight. Simple.
Trade payable is the first one.
Uh-huh.
The
How much?
trade payable is 15,400.
You put it in bracket.
Yes,
What
sir.
again?
Then we have debenture, 10%.
Come again.
Debenture, sir.
The venture tax percentage. You see, all these things gives you marks.
Yes, sir.
You put the percentage behind it. That's how it is done. Oh.
Okay, sir.
So what is the percent? What is the value?
Debenture, the value is 12,000, sir.
What again?
We don't have anything now. When we
The,
go to equity,
okay,
then we
let's
can
go to
talk.
equity.
Equity, we have revaluation surplus and earning, retained earning.
All those
Finish.
ones they have no effect here. I've already told you the formula.
Yeah.
So go
Yes.
straight to the
Yes.
point.
So now let's go to the additional
No, 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 no.
relevant.
Go straight to the point. Go to when you go to the equity, there's some one item that affects. So when you look at it, when I look at, I can see the question here. I can see it given here. Look at it. They've given you in the additional information. They've told you that there's what the 20% return preference shares. Charlie, you should be very, 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 very mindful of these things. Oh.
And so I'm saying let's go to the additional notes.
Okay,
They
okay,
have
okay,
20. Yes. They
okay,
have 20%
okay, okay,
redeemable
okay. That's fine.
preference shares.
That's fine. That's
Yes.
fine. Okay. Preference shares. Okay.
That is 10,000.
10,000. Good.
Yes.
So we are done. Then when you then you do the additions.
So let me ask this question though.
Let's go.
I was about asking, you see, the other one was irredeemable,
Yes.
and this one is redeemable.
Yes.
Why that, sir?
Why which one?
Why are we using it? The
But
other
you
one is
but I'm
irredeemable.
coming, I'm coming, I'm coming. But you know that we have different types of preference shares,
Sure.
right?
Yes, sir.
redeemable preference shares and irredeemable preference shares. One is what we see. What's the, like? Just look at the name, redeemable, because one is irredeemable and one is redeemable,
Yes, sir.
right? So
Yes, sir.
if you want to know the difference between the two, now what? Listen, the normal preference shares, uh, they have the right? The redeemable preference shares, they have the right to, uh, like you see, who issued the redeemable preference shares? You understand?
Redeemable.
Who issued shares? Who issued shares?
That is the entity.
Good. That is the company, right? So if the company issue preference shares and they can buy it back, we call it renewable preference shares.
Okay.
Do you understand?
Okay.
Do you
Yes,
understand?
sir.
But you
I
know
get
that
you.
share can be bought back.
Sure.
Do you understand? Shares
Yes.
can be bought back by the company. You understand?
Yes,
Because the
sir.
shareholder can decide to what the company can decide to what buy back their shares, depending on the type of the share they are issuing. The same thing applies to preference shares. Preference shares. Preference shares can be redeemed. It means the company can buy back the shares that they've given to us to the preference shareholders.
Shareholders.
So if a share can be bought back, we call it redeemable preference shares. Please, are you with me?
Thank you.
Do you understand?
Yes, sir.
But when it comes to irredeemable preference shares, they are what? They are permanent shares unless the company is collapsed. You understand? So irredeemable
Okay.
preference share, it means the company cannot, or the company has no period of what retrieving or buying back the what by the buying back the shares. You understand? And
Yes, sir.
it's not obligated for a company to buy back the shares back.
Yes, sir.
We call it irredeemable preference shares. But what I say? So that's the difference
That's all.
between them. But their activity or how we do their entry here is the same. Please are with me.
Yes, sir. Thank you very much.
Okay, so add them up.
I have 150,000, 176.
Come again.
150,000,
Uh-huh.
176.
Okay.
176.
Okay. So this is what? Business value. Okay, let's go. So now you can now what is the shares?
The
Now
business value.
shares. Come again.
The share.
Shares. Now go to the what? The equity capital. What is the equity capital of the company? What's the equity capital of the company? Part check
No,
number.
50,000.
Come again.
50,000.
Part SN.
50,000. 50,000.
It's not
50,000.
50,000. Check the question or share additional information. What can you see there?
Uh-huh. That is 40,000.
Yes, that's what you are working with. Oh, please.
Uh-huh.
Your 40,000.
40,000 divided by 20.
And they tell you that share price is what? Is 20
20.
pesos. So you see that shares will be what? 40,000 by 0.2. Every month, how much?
40,000.
Huh?
Yeah. Say I'm coming over.
Oh,
Yeah. 200,000.
okay. So now value per share. We'll give you said it is what? 150,000
200,000.
150,000. 176 divided by 300,000. How do you have?
0.75.
Like this.
Where is it? I can't see it. 0.75. Oh, not here. Oh. No, 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 no. The answer, the final answer.
Uh,
Uh-huh. The final answer. Correct. 0.75.
okay. Okay. Good. We are done with first one. Let's go to
Yes, sir. The second one.
price earning ratio. What is the formula?
Market price per share
Over what?
for earning per share, sir.
Okay, so
So we
how do you
have
say what?
market price per share equal to E ratio
Okay, so
times
here,
earning.
when you are done, then you come and look for it one by one. You said we should always have our price earning ratio.
Yes, sir.
Okay, so price earning ratio. How do we find the price earning ratio? In the question, did they give you? So here, this one is what?
We have the limit.
I need that so.
Yes. And we have been given the industry.
And the industry is what? Abiola, right?
Yes, sir.
Good. Now check in the question. Did they give you PE ratio of what? Of the industry?
No
So how do we find it?
P ratio. There's the formula to find that.
Come again, sir.
We have a formula to find it.
So how do we find? So what is the formula to find it?
That is market price per share over earning per share. And we have market capitalization.
We have
Let's
market
take
capitalization. So now here, so what we want to say is that so we have PE ratio is equal to what? Uh, MPS over what? Over EPS, right? Is that not the
about.
case?
Yes,
Hello?
sir.
Now so now we are coming to find
Yes, sir.
we are not coming to find the PE ratio of what? Of Abiola, right? Because they didn't give.
Exactly.
So we need to look for it, right? So how do you pick the what? You use this formula to do that. Now, where do we have the market price per share of what? Of Abiola?
We have
So now, so how do we find the market price per share of Abiola? Market price per share of Abiola would what? Market price is what? What is the market price? Market price of Abiola is what? So you come here, watch here. Market price. You first find the market price. Now, the market price, as you are saying, they've given you what? Go into the question. Have you seen how they count this question?
yes.
If you don't learn like this, there's no way you can what you can know this one. Market, have you seen they give you market capitalization of 1 billion? Have you seen it?
1 billion. Yes, sir.
You understand? And they've also given you the number of ordinary shares. You understand?
Yes, sir.
So market price per share, it means this is the what? The total capital the company is allowed to float in the market. And then they said the total market value of the
Yes, sir.
800,000 share they are going to float. You understand? So here the 1 billion is the what? Is the market value, total capital. And they've given you, let me make it in the form of notes for
Yes,
you
sir.
to see. So you will see that
Value.
market capitalization, you see that is the what? Is the what? Is the total capital value. Capital value is what? Is the 1 billion that they what? They have what? They have issued. You understand? And then the number of shares is what? Is 800,000. You understand? So if you want to know the what? The market
Yes.
price per share, you understand? Because the market price per share is the what? Is the capital value over number of shares. Do you understand? Aha.
Yes, sir.
So the capital value over number of shares, where you have what? The 1 billion all divided by 800,000. What do you have?
Point two
So
five,
you have 1.25,
sir.
right? 1.25. Okay, let's go into the question. Did they give you earning per share? Yes, they've given you what?
Yes, sir.
The earning
Yes,
per
sir.
share. So
Abiola.
I build that they've given you the earning per share was 0.2. So here you can now find your what? Market PE ratio for what? For Abiola, which is what? 1.25 divided by 0.2. What do you have?
I'm coming over.
Um,
Abiola.
let's go.
1.25 divided by 6.25, sir.
6.25 being the PE of what? Abiola. Now we know PE of Abiola.
That is 6.25.
Yes.
Abiola.
Yes. So 6.25 is Abiola. So Abiola is what? 6.25 for Abiola. So how do we find Anidaso? Now, Anidaso,
So we come to marketability.
absolutely. So what is the marketability risk here?
We are giving 10.
Hey, are you sure? Let me check it.
Cost of capital.
Hey, that one, that's not the marketability risk, oh, my brother.
Uh,
That's the cost of capital. That one is different from marketability risk. I beg.
so we have to assume or what?
You should assume. That's what I've been telling you. If not given, assume. So in the question, they didn't give you marketability risk. So if they didn't give you marketability risk, then you can what? You can use the I've told you what you should do.
Yes, sir.
So what do you do?
We
So
assume.
so you do what? Assume risk. How much are you taking place?
Oh, 20.
Come again, sir.
20%, sir.
20%. So as not assume risk. So 20%. So you have your what? Your 100 minus what? 20. What do you
Well,
have?
give
You
me
have
80,
what?
sir.
80%. So here
80%.
you will have your what? Your PE for Anidaso. I guess you what? 80% times
5.
what? What do you have?
6.25. 6.25.
So what do you have? 80% of that is what?
5. 5.
5. Okay. That's fine. So yeah, Anidaso will be what to 5. Simple. So now you have it. What do you do? You have your what? NPS or value per share to what? To the PE times what? NP earning per share.
So we have to find any per share. We've not gotten any per share.
Hey, so let's come to earning per share. Earning per share.
Thank
What's the
you.
formula for earning per share, please?
We said uh, profit after tax
Of the tax minus any preference
minus
what?
any
Dividend, if
preference
given. All divided by what?
equity
Number
share.
of shares. Right? Okay. So now the earning per share, you will start with your
Hello?
profit. So now
Yes,
check the
sir.
question. Do we have profit? Do you have statement of financial P&L?
Yes, sir. We have small
So
P&L.
profit after tax is how much?
Profit after tax is 14,250.
That's what after tax is what? 14 what?
250.
Okay, let's go. Is there any adjustment that needs to be done here? So before you do that, come to your net assets. That's where you will see the adjustment, if any. You see, come here.
Uh,
Have you seen it?
okay.
Please, do you understand what we are
Yes,
doing?
sir.
Do you understand?
Yes, sir.
Yeah, you see that there's no
Yes,
adjustment.
sir.
There's no adjustment linking to P&L. So there's no adjustment to be done here.
Whatsoever, sir.
You understand? So what you have to do that check if there's any preference dividend in there. Is there any preference dividend? Do you have preference dividend?
Preference dividend. Yes, yes.
Check if there's preference shares. Check if there's preference shares.
Irredeemable.
Eh? Oh, don't let us sleep over this one. Oh, we've done this one over.
They're redeemable. 20%.
Okay, so good. So preference dividend.
They're redeemable.
So how much? What is the total? What is the total irredeemable preferences?
Okay. It's there. Dividend paid.
No, 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 no. Check the total preference shares. That's what we are
Dividend.
using.
Oh, sir, check it and see. It's
It's what?
10,000. 10,000. 10,000, sir.
Okay, you multiply. What do we have? What do we have?
2,000. 2,000 Ghana cedis.
What? 12
12,000.
and 50. Okay, so this becomes your what? Your earnings. So this is what? Adjusted. Now, you can now find out what? Our earning per share. So our earning per share is what? Earning divided by what? By the number of shares. So the earnings is what? 12250, all divided by the number of shares. How much? 40,000 or 4,000. Is it 40,000 or
Divided
4,000?
by 20, so 200,000. We had it.
Okay,
200,000.
yeah. 200,000. Yeah, all right. 200,000. So how much? Any purchase is how much?
So I'm doing it for you. 0.06. Yes, sir.
Is that all?
Five. Five.
Okay, so now we have this. So we can comfortably
Yes.
find our what?
You had
MPS
five. Five. Correct.
or what? Value multiplied by what? Earning per share. So here, PE is how much, please?
We had the PE to be five.
5 multiplied by 0.06125. What do you have?
0.306.
Okay.
Yes, sir.
We
You're
are
right.
done with, we are
Zero
done,
six.
we are done with,
306.
okay. We are done with,
306.
so we move to
Thank you.
point 3,
Dividend yield.
dividend yield. Now, dividend yield, the formula is what?
Dividend per share.
Dividend per share, all divided
over
by what?
market price.
NPS. So now this one gives you what? Our interest is what? NPS
MPS,
is equal to what?
dividend
Dividend
per
per
share,
share over what? Over
dividend yield.
dividend yield.
We
That's it.
find dividend yield.
Yes, so find dividend yield. So you said we should find what? Dividend yield. Right. So when I find dividend, we have what? I need that so here. And then we have Abiola, the industry. Now let's check. Do we already know for dividend yield for the industry? Do we know the dividend yield for the industry? Hello?
No, we don't know, but we
Was it given in the question?
can calculate.
Come again. Your line is breaking up. Hello?
We can calculate
Ah,
that we can
we
use.
should calculate. Hello? Oh,
Yes, sir.
okay. So if we are calculating, if it was not given, then we come to what the Abiola. So here, Abiola dividend yield is equal to what? Dividend per share of Abiola over what? Over market price per share of Abiola. Is that not the case?
Yes,
Eh?
yes, sir.
Good. Now let's go into it.
Yes, sir.
Was Abiola giving dividend per share? Do we know the dividend per share of Abiola?
There's
What's the
nothing like that.
dividend per share of Abiola? Check. Go to the additional information, the Abiola, you see the information given in respect to that.
Okay.
Have you seen dividend? Aha. Have you seen the earning per share of Abiola? Have you seen it?
I've
Please
seen
follow me.
the
Have you
earning
seen
per
the
share
earning
of
per
Abiola.
share of Abiola? Have you seen it?
Yes, sir.
Have you seen it? Okay.
Yes, sir.
Interesting. Watch here. We can use two means to do get this. But let me use the one that is well understandable for you. Are you with me?
Yes, sir.
Are you with me? Now watch here.
Yes, sir.
Watch here. You know that dividend is paid out of earnings. You see, earnings is equal to net profit. Do you know that? Please, do you know that?
No, sir. Sir, explain it to me.
Do you know that?
No, sir. Sir, explain it to me.
Usi no.
Oh, yes, I'm aware.
Aha. And remember, dividend is what paid out of what earnings. Please, what you say? What did I mean? Answer. Follow
Yes, sir.
me because the nature of this question sometimes it's a bit tricky. One are very careful. Aha. Or what? Or your what? Your net profit, right? Okay. Now watch here. Follow me here. Small, small. Now in the question, you should have more. Who follow question now? Look at what they gave you. They've given you earnings per share. What? Have you
Yes.
seen? Earning per share, what earning per share?
Earning per share is 0.2.
0.2. What does it? Good.
That's it.
And normal number of shares. AI.
Number
Number of shares. AI.
of shares. That is the 800,000.
800,000.
800,000. Yes, sir.
And then who pursue who total earnings are saying or profit are saying. What I say? A unit earning per share times 800,000. I am saying.
I'm coming over.
Demi, what you say?
I'm, I'm seeing stars.
You are seeing stars.
Yes.
Oh,
Bring me home, sir.
was there anytime I'm away? Medical amount earnings or net profit. Earning is equal to net profit. Example, if a company, maybe a company A, the net profit is the net profit A be 20,000. And then the shares is the shares A be a 50,000 shares, right? And I say be the shares a 5,000 shares. So you know be when say earning per share about 20,000 divided by 5,000. But what I say? You don't say
Okay.
earning per share 10 series. But what I say?
Okay.
And then say, oh, question me, your mouth say company A earning per share 10 shares 5,000. The total earnings no S or profit no S. But what I say? Ebemau,
Yes,
the reversal. But what I say? Ebemau,
yes, sir.
10 multiplied by what do you call it? 10 multiplied by no. What do I do? This one,
3,000.
this divided by this will give you how much? 5,000 divided
Which
by
one?
20,000 divided by 5 will give you how much? I think 40 and a
50,000 divided by 5.
And 20 divided by 5 will give you what? 40.
The 40.
Aha, so you know, the amount say earning per share 40. Number of shares 5,000. The earnings 40 multiplied by 5,000. That gives you what? 20,000. The earnings. What I say?
The Air 4.
4, okay.
Air 4. Air 4.
But until what do you answer?
Yes, 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 yes. But yes.
But what I say? Until I say what is the profit or earnings are? Obefa ne you know, what do you call it? The earnings per share multiplied by number of shares are ebema the earnings, the total earnings are unyai. But what I say? Using this as an example. Until I say
Thank you. I try.
one more profit, one more shares.
I'm cool
So
now.
earning per share ebema 4. But what I say? And you got to find
I
the
try.
earnings are the reversal. Into offer the number of share, now
Of it.
multiply units per share. Ebema the earnings are
Thanks
unyai.
there. No, that's all.
But what I say?
I try. So let's go.
Aha, ebia na ye face challenge a ye face wa no. Wo hwa question ni mu a, wa ma earning per share 20 pesos. And amount the number of shares being 800,000. So you can't also find the total earnings are over fine.
So you multiply
What I say? And to be say,
160,000.
I
160,000.
160,000. What I say?
That's why.
So to be say the earnings or profit I before almost calculate we no 160,000. What I say? And then the question, what catch us
Yes.
say dividend payout.
80%.
I
80%.
what I say?
Yes, sir.
Follow me keenly here. So one says so now also almost declare say they are paying out what 80% as dividend. What I say? Yo. And
Yes,
if they
sir.
are paying out 80% as a dividend, then that means dividend no EBS. Dividend paid BSN, the 160,000 multiplied by 80%.
80%. 128,000.
I
128,000.
Pato to was it? Everyone's
1 128,000.
one
28,000.
128. Okay. So this becomes your what? Dividend paid. Nti ase wo.
Thank you.
Pato nti ase wo.
Yes, sir.
Good. 128,000 and 80,000. Pato
8,000.
8
1, 2. Well, you are
8,000.
correct, sir. It's correct. It's
Okay.
correct. It's correct.
Nti ase wo. Nti yenko enim.
Yes, sir.
Good. And you know if say dividend omutua yeni a, then dividend per share be sen. Dividend per share. I thought dividend per share dividend per share equal to uh dividend declared divided by number of shares. Okay.
Yes, sir.
What I say? So I'm going to declare 1 to 80,000. 8,000 divided by number of shares. Number of shares are 800,000. Don't forget. Ubenya saying.
So,
Ubenya saying
0.16.
0.16. But what I say? This is the nature.
Yes, sir.
That is the nature of the question. So my main found from the last one on that. Watch this.
Thank you.
Almost per your friend is saying dividend yield. Dividend yield no unni your friend say dividend yield of ability. So you need to find it. So how do we find it? How do we find it? You will find it with the formula dividend per share or what NPS. Now in the question, your friend say we earning per share and number of shares in the what floated by what by the company. So how do you find the earnings? How do you find the dividend? But what I say, how do you find the dividend? You know the earning, unit earnings, and you know the number of shares. A bit mama the total earnings are company in the year because Oma Catch was say out of the earnings, you 80%. But what I say, out of
Yes,
the
sir.
total earnings, you 80%. You 80%. Say 80%. How do we a better than earnings on the calculate 80% from the earnings? Only unit per share, a unit earning unit, two. Only number of shares into multiplier, a amount the total earnings are company now 160,000. Now if you work calculate 80% payout now almost all my amount what? Total dividend or matua out. So when you total dividend or matua out divided by number of shares and amount what? Amount dividend per share. What I say? But
Yes,
what
sir.
I say?
Yes, sir.
Now alternatively, share the amount earning per share. Earning per share is 0.2. And amount dividend payout 80%. So into
Yes,
who
sir.
say dividend per share about 0.2 times 80%. Listen,
Let me go. 0.16.
0.16. Won't say the same thing.
Yes.
Won't say the same thing.
Yes, sir.
The first one I'm here anyway, won't say the same thing.
Yes, sir.
Eh?
Yes, sir.
Now, earning per share no, say till earning per share no say your profit a company no enya, you divide by number of shares and the earning per share. But what I say? But dividend you
Yes.
be to your free mono. A saying what I never my the total dividend per share. And you know, out of ebia ukita share bia watch here. One share bia.
Let me go. Sir,
Yeah. Mm-hmm.
you said earning per share no,
Yeah.
is profit yeah, divided by
Yes.
number of
Number of
shares.
shares and every more earning per share.
Yes, sir.
Sabre ni entry dividend.
Yes.
What does sabre ni entry dividend here? So unti entry dividend earning per share. Ukita into that means ukita one share bia you earn what 0.2. What I say?
Okay.
What I do get a one share bia or earn is 0.2. That's the meaning. Earning per share. What I do get a one share bia the obenya is 0.2. So here no you a dividend yet. Dividend has not been paid yet. What I say? Anthony said if you should pay dividend out of the 1.2 because 0.2 no it belongs to the company. They've not paid dividend to any person yet. And almost 80% from earning per share. So much 80% there. Much 80% there. O calculate 80% on 0.2 and what do you call it 0.16. What I say? So it means right now no ukita one share bia ubenya dividend of 0.16. Are you following?
Yes, sir.
The rest would be a retained earnings to the company. And then out of 0.2 no, only 0.16 and they are chiama shareholders. Not the rest will remain as what retained earnings. Do you understand?
Yes, sir.
Do you understand? Or you are still confused?
Okay. It's okay. It's okay.
Okay.
So it means the retained earning will be 0.04.
Absolutely. So that will go
That,
to the balance sheet. Are you with me? Ah. So you look at it, you will look at it from that perspective. So earning per share means that the total
the
earnings, the total
balance sheet.
profit of the company divided by the number of shares. You understand? But the dividend, you can calculate it. When we calculate, you see here, when we calculated the dividend payout, It is the total dividend. When you calculate it on the total earnings, it will give you the total dividend to be paid. You understand? But when we calculate it on earning per share, it will give us what? The unit dividend. You understand? But when we calculate it, when we calculate the 80% on the earnings, it will give you our total dividend to be paid. But when we calculate it on what? Earning per share, it will give you what? Unit dividend per share. But when we calculate it on the total, and it will give you the total dividend to be what? To be paid. Unless you divide it by the number of shares, that gives you what? The unit dividend to what? To be paid. Are we okay? Are you okay?
Yes, sir.
Okay, so yeah, now we know. So now we know Abiola to be what? 0.16. Is that not the case? Dividend yield is 0.16. Is that not the case? Or what? That one is dividend per share, right?
Yes.
That one is dividend per share. Okay.
Dividend per share is 0.16.
Dividend per share is
Yes, sir.
0.5. Okay. So we should find the what? What are we to find now? Market price per share, right?
Yeah. Market price per share.
So NPS of Abiola is how much? We already know. We've already calculated it up there. So that one, I said that the capital value of the what? Of the company divided by what? By the number of what? Shares. Yeah. Are we okay?
Yes,
Are
sir.
we okay?
Yes, sir.
So now the capital value is how much? The capital value was 1 billion divided by number of shares, which is 800,000. What did we get in our sign?
Then, sir, divide this
In our sign, it's up there.
800, yes. Right, let me do it, please.
It is up there. 1.2.
1.25.
Okay, so here now we have our entry. So now we can calculate our dividend yield to be what? To be what? Dividend per share over what? MPS. So here,
Over
this one is what? Dividend
MPS.
per share is for 0.16 and then 1.25. What do you have? What do you have?
I'm coming.
SI?
0.12.
Is that the answer?
No, we are not done yet.
No. DY is how much?
0.128.
0.0.12.
Yes, 8.
Leave, eh?
8, 8, 8,
8.
8.
So now we know our what? We know our dividend yield to be what? 0.12. So if Abiola is 0.12, then this person will be how much? And it also will be how much? I say when you are doing the division, the adjustment should be what?
Adjustment.
You will do
Then
what?
here we have to increase it.
You have to do what?
Increase it to be 20 plus 100.
So and it also adjust. Adjust upwards or downwards.
Up.
And it should be consistent. It should be 20%, right? So you have 100 plus 20. That gives you 120%. So you will have what? 120% times what?
Done.
0.128. What do you have?
Done. 0.15.
0.15. Uh-huh. Leave it 3 decimal
Yes,
place at all
sir.
times. Huh?
Yes, sir.
Leave it 3 decimal place at all times.
Okay, sir.
That's what. Oh, all right. So let's move. Yeah, this one will give you 0.154. Okay, so now we have this. Now we can calculate our NPS. Is that all?
We've
Hello?
gotten, yes, sir. We've gotten the truth.
Is that all? So now we've calculated the, so now um we know the we know the dy. We know the dy. So we are left with what?
Um, if you know the DY, then we are left
Dividend per share.
per
And
share.
that's so.
Dividend per share.
You understand? So dividend per share of Anidaso. And I said dividend per share is what? Is what?
Dividend per share
Shareholders
is
dividend divided by what? Equity shares. Right? So here, shareholder dividend is how much? Check for me.
shareholder dividend. That 2,000.
So this
20,000.
one, you have to less preference dividend if you have any. Check the first formula that we did. So if there's any dividend they declared, then you less any dividend from what? From shareholder preference shareholders. Okay, so let's go. Check
Okay.
the question. In the question, check the if they've declared any did they propose and it has did they propose any dividend? Check in the statement of P and L. Check
They paid out. They didn't propose.
dividend paid out is how much?
6,200.
Huh?
6,200.
Uh-huh. Dividend proposed or declared or paid out.
Dividend paid out straight.
6,200. Okay.
That's it.
Okay. And preference share, do we have preference share dividend also?
Preference share, yes. Preference share. That's it.
Preference shares, preference dividend. How much did we pay preference dividend shareholder?
20% of 1,000.
Check here. Check here. Preference dividend. Have you seen it? Have you seen it? Preference share
Okay.
is 10,000, 20% preference shares. Have you seen it?
That's it.
Times 10,000. What do we have? You will have what? 2,000. When you less it, what do we have?
4,200.
4,200. So now we have our, so now what is the number of shares do you have? We have 200,000 shares. So you know you have a dividend per share to what? 4,200 divided by what? 200,000. What do you have? The dividend per share.
Is it 200,000?
Come again.
No, you are right.
Okay. So what is the dividend per share is how much?
0.021.
0.021. Okay, so now we have this. So now we can have our NPS or value per share,
Dividend per share
dividend
over.
per share divided by what? Dividend yield. Now
Dividend
dividend per
yield.
share is what? 0.021. Dividend yield is what? 0.154. Divided. What do you have?
0.136.
Okay, so 0.14. We are done with this one. Then we go to the fourth one. The fourth one is what? The
The
fourth
fourth
one
one is discount factor.
is counted cash flow. Granted cash flow. That one we know what to do. So here, now you start with what? Your number of years. So we start with what? Your this one, you go straight to your cash flow because we are not going to do any adjustments. You remember?
Yes, sir.
We are not doing any adjustment because depreciation is not deducted. You understand? So which year are we starting from? Accounting year ends
Yeah.
2019.
So 2020,
So you have 2020, 2021, 2022, 2023, and 2024. Now, cash flow for year one is how much? The profit is how much?
14,
14,900, 16,000, 19,250,
19,
19,800, and you have 21. Okay, so you have DCF. So what is the, do you know, now you can calculate the what? DCF, DCF, right?
yes, sir.
1 plus R to the power negative n. So please do the math for me.
That's the 10%.
Yeah, 10%. How do you
0.
write? 0.
0.
Point,
909.
okay, so do the divisions.
0.826.
Okay, 0.751,
0.751.
0.683, 0.621.
0, you are right.
Okay, so now we'll do the multiplication. Let me see. 2020 is how much?
You are coming. 13,
Okay,
544.
4 4 and a 4 5. Can you round it up?
44, sir. Let's make it
Go on.
13, 216.
Okay, 13 2.
16.
Okay, go on.
14, 45. 13, 523.
13
523.
13 5.
23.
Okay, last one.
13, 383.
Okay, sum them up. So this becomes your what? Business value. So your number of shares. Okay, divide please. What's the total value?
I'm coming. I'll give you 56. 123.
66. 1 2 3.
Five, no, 56. 123.
68. 1 2
See,
3.
123.
Okay. So when you divide it, you have your value per share
0.34.
divided by 200,000. 0.34.
0.34.
Okay. All right. So that is it about that. That is it about this question also. Take note of this very question. How, especially, you have to go and derive all the industry adjustments. That is where the problem is. So you should know that. Are you with me? Uh-huh. So
Yes, sir.
please, we will come at 8 and then
Hey,
we should come at 7:30, right? Okay.
let's see that way.
Come again.
7:30 will be okay.
Okay, so
Even let's make it 7:30.
okay, 7 7 it's actually 7:30 will be here. Then we can complete the last one, then we move. Do you understand?
That's all.
Then remember, we will not come back to business valuation. All
No, no,
that
no,
I'll
no,
do
no,
is
no. We
that,
are moving away.
yeah, I'll give you examples for you to solve.